Why do some investors end up with amazing returns in franchising, while others deploy capital into what looks like a good brand, only to realize that they're betting on the wrong structure entirely? And why is it that private equity consistently chases franchise platforms, even when the individual brands themselves don't look great on the surface? I'm Justin Kaiser, CEO of Empire Franchising, and I've spent the last 24 years building, scaling, and investing in businesses, including taking my own company from scratch to over 100 franchise territories before an acquisition. And I can tell you that the answer is simple, but most people miss it because they're focused on the brand, not the system behind it. They're evaluating logos, concepts, and short-term traction instead of asking the only question that really matters. Can this thing scale predictably? And can it absorb capital efficiently? At Empire Franchising, we've built our entire model around this idea. The real value isn't created by scaling one franchise brand. It's created by aggregating multiple brands into a centralized platform that compounds growth, efficiency, and ultimately valuation. Franchising, when structured correctly, is one of the most powerful asset-light models in business. You're not holding real estate. You're not carrying labor. You don't have the day-to-day operational burden at the unit level. Instead, you're owning the brand, the systems, and the revenue streams such as franchise fees, royalties, marketing contributions. And when those are scaled across dozens and ultimately hundreds of locations, you create something that investors actually care about: predictable, recurring cash flow. But predictable cash flow alone isn't enough. What matters is how scalable and repeatable that cash flow is, and whether it can grow without breaking the system. Now, let's take that one step further. Instead of a single brand, imagine a platform that owns equity across multiple franchisor brands, each one feeding into the same centralized infrastructure: marketing, lead generation, franchise sales, onboarding, support, and more importantly, data. Because as more brands move through the same system, you start to understand what actually drives growth at the granular level. You understand what channels convert, what messaging works, what unit economics hold tight. And that insight is what compounds just like the revenue does. And this is where the model starts to separate itself, because your cost to grow doesn't increase linearly with each new brand. It decreases. And this all happens while your revenue base expands, your efficiency improves, and your feedback loops tighten. Also, your ability to deploy capital with precision gets stronger over time. That's operating leverage, and that's what drives multiple expansion, not just revenue growth. Because investors don't pay premiums for effort. They pay premiums for systems that can scale without friction. And this is exactly why investors who understand this model don't just invest in brands. They invest in platforms, because a single brand carries risk, market shifts, leadership changes, industry cycles, execution risk at the operator level. But a portfolio spreads that risk across multiple verticals, stabilizing cash flow and increasing the overall value of the system. And when risk goes down, valuations go up. It's that simple. Now, layer in aggregation, because this is where outcomes change completely. Most operators think in terms of building one business to a certain EBITDA and then hoping for a decent multiple on an exit. But they're playing a smaller game without realizing it. Because when you structure multiple brands under one platform, you're no longer selling individual companies. You're selling a system, a portfolio, something that institutional capital can deploy into and scale. Something that doesn't rely on one founder, one concept, or one market. And that's where you start seeing the jump from average multiples to premium outcomes. The same underlying economics, but completely different perception of value. And perception is what drives liquidity, because buyers aren't just buying what exists today. They're buying what they believe can scale tomorrow. And a platform gives them that confidence. Now, let's go one level deeper, because this is where most people lose the plot. Ownership structure. If you build brands independently, you end up with fragmented equity, different partners, different incentives, complexity that makes it harder to consolidate value. But when it's built through a platform where the platform owns meaningful equity in each brand, you're not just creating growth. You're consolidating that growth at the top, which ultimately is what gets valued and ultimately what gets sold. And that's how you turn multiple good businesses into one great outcome. Now, here's where Empire Franchising comes in. We're not starting from scratch. We've already proven the growth engine behind this model in an industry where most franchise groups have a 2 to 13 times higher cost per franchise acquisition than we do. We've consistently operated at a fraction of the industry average, and that's not just a metric, that's an advantage, because efficiency at the unit level turns into scalability at the system level, and scalability is what drives enterprise value. And that efficiency becomes a force multiplier as more brands enter the platform. Every new platform partner doesn't start from zero. They plug into an engine that's already built, already tested, already producing results, already refining itself with every campaign, every franchise sale, every onboarding. And as the ecosystem grows, so does the value at the platform level. This is where investors participate, not in one outcome, but across the entire portfolio that we're building, across multiple brands, multiple revenue streams, and multiple paths to exit. That's the shift. This isn't about investing in a single franchise concept and hoping that it scales. This is about stepping into a structure designed to create, grow, and position multiple franchise brands for long-term value and eventual exit. This is about alignment, where the platform wins when the brands win, and the investors win when the platform compounds. So the question isn't whether franchising works. We all know it works. The question is whether you're positioned inside a model that actually maximizes its potential.